Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Rob Kirby. Rob runs the website kirbyanalytics.com, and I am very happy to have him back on the X22 Report Spotlight. Rob, welcome back to the Spotlight.
Pleasure to be with you again, Dave.
Hey, thanks for being here, and there's a lot going on right now, and I wanted to start off with your take on the economy. Last time we spoke was back in January, before Trump was inaugurated. Since January up to this time, what's your take on how the economy's doing? Has it gotten better? Has it gotten worse? Where are we right now?
I feel that the U.S. economy has deteriorated significantly since we last spoke. Retail, in my view, has pretty much flatlined in America. Projected retail closures this year, I was reading a couple weeks ago, the anticipated closures, everything from Sears to, there was a host of retail brick and mortar places that were due to be closing this year. And we've also, as evidence that the economy is slowing, we've also seen the Fed back off from its bellicose chatter about rising rates or raising rates. And it would seem to me, at least, and I know we have a Fed decision coming on interest rates, and I think the consensus currently is that the Fed is expected to do nothing, as in leave rates as they are. And this, in my view, is very consistent with the poor performance. We've had downward revisions in GDP. The economy is not doing well, plain and simple. It just isn't doing well, and there's plenty of economic data reporting to back that claim up. So as a result, I see very likely, I'll be surprised if we see another rate rise this year. And come fall, I think the Fed might be posturing to lower rates again.
Wow, so you think they're going to start lowering rates because they realize that the economy is not doing what it was supposed to be doing, where they thought it was going to improve? Because other parts of the Fed, I hear that they're expecting the second quarter to have, I think, around a 3% GDP rate. I mean, I don't know how they're going to get that. I don't even know where they came up with this number. But they were saying, oh, this is just a one-off thing, and the second quarter, it's going to be much, much better. I mean, do you believe them?
Well, Dave, listen, the biggest telltale, probably, and most people who watch interest rates, I believe, would concur with this claim. Back when we spoke in January, the 10-year bond, I think, was probably yielding a little north of 250, or it was certainly around 250. And if you look at where it is today, it's around 230. And it's been as low as 221 in the last week. But anyway, in a big picture sense, what we've seen occur is the yield curve is flattening. The 2 to 10 year spread has flattened dramatically. And a flattening yield curve is usually a harbinger of a recession coming or weaker economic times in the offing. So from that standpoint, I would say that the bond market is concurring with the notion that the economy is slowing on top of all the empirical data.
So if we're heading into a recession, there are some people out there saying that we're already in the recession. Do you think the Fed is going to have to increase stimulus once again?
Yes, I think it's just a matter of time before we see it. And whether we get an outright QE or whether we just see them back off on the Fed funds rate, it's funny. There are many different ways you can put a beard on an easing. You can do it by lowering reserve requirements for the banks. You can do it by lowering the Fed funds rate. You can do it through open market operations in the bond market, whether it's like an Operation Twist, or whether it's outright purchases, of of government bonds in the marketplace.
Now, you're in Canada, correct?
Yeah, Toronto, Canada.
In the news, we've seen Home Capital Group where they're having a huge amount of trouble, and it looks like they've been bailed out, and people are very nervous about this. What is your take on what is going on with Home Capital Group and the housing market in Toronto and Vancouver? What do you see up there?
Home Capital is something that I've been passively following for the last couple of years. A just sacked chief executive of Home Capital was a client of mine in the interbank market in the 1980s when he worked for Deutsche Bank, and his name is Martin Reed, and he was just recently let go of his position from as the CEO of Home Capital. And my view of what I've been able to consume publicly regarding their fate, the public message that's being fed to the public by the media is that they had issues 2 years ago where they had independent brokers who were feeding them mortgage applications, and the concern was that the applicants were effectively did liar loans. So, and for people who don't remember what liar loans are all about, it's when people come in and say that they have an income of X when they really don't, and they qualify for the mortgage on the basis of having an income of X, and they don't have it. And then, as a result, or the ultimate outcome of all this is that the mortgages don't perform, and if the mortgages have been bundled and sold as a mortgage-backed security, the people that are in possession of those mortgage-backed debt obligations, could have failing grade paper when they thought that they were buying something that was, let's just say creditworthy. But let's just say this in relation to Home Capital. To begin with, Home Capital is an alternative lender, which means that anybody who'd be buying bundled mortgages from Home Capital knows that they're coming from the alternative space, and they typically are not insured mortgages. So the people buying this kind of a debt obligation would have a higher appetite for risk than somebody buying insured mortgages. And the other thing that's occurred, because it's been well reported in the Canadian media that the issue of brokers sending unqualified mortgage applications, that issue was dealt with 2 years ago. And the issue was supposedly addressed. And then when you factor into the equation that Home Capital does virtually all of its mortgages that are on their books are in the Greater Toronto Area, and when you consider that the Toronto area in the last 2 years has home prices across the board have appreciated probably somewhere in the neighborhood of 70 or 80%, this whole stated issue of what's giving them problems, in my view, should be non-issues. Because what's occurred in the Toronto market in the last 2 years since they addressed the issues they had should take away any problem there might have been with the collateral being, as in the value of the home, not covering the value of the mortgage. There should be absolutely no loans on their books where they be upside down on a mortgage. So I don't really see what the issue is. My true guess is that it's something that hasn't been stated. And I'm not saying that there hasn't been malfeasance. I think there has been malfeasance. Very likely has been malfeasance at Home Capital. But my guess is the people that have actually been engaged in the malfeasance probably have not been accurately identified as yet. and very likely the people who've been engaged in the malfeasance, they're very likely looking for a patsy or a fall guy. And with regards to the chap that I used to, he used to be a client of mine who was the former CEO there. When I knew him in the 1980s, I would have classified him as a person of extremely high regard, extremely straight shooter, and an extremely honest guy. So the real story of what's going on at Home Capital, I don't think we know the real story as yet. And how it falls out in what a lot of people consider Toronto to be a bubbled real estate market, we'll have to wait and see, because I don't think the book is closed on this yet.
Do you think once the bubble pops, this is going to hit many of these type of companies?
Well, I mean, Home Capital is really something unto itself in the portion of the market that they've carved out. But that being said, they are a large provider of liquidity in the alternative space. So people that do not qualify for bank financing, and people who do not qualify for an insured mortgage, these are the kind of people that may be somewhat at the margin. But these people Home Capital added liquidity to the financing possibilities for real estate in the Greater Toronto Area, a significant source of liquidity. And with that being taken off the board, there's going to be less mortgage available to people who are marginal qualifiers to own a home. And there's also the issue of their outstanding book. If the company's forced into a liquidation, who's going to pick up the pieces? Because the pieces, the type of mortgages and the type of credits that Home Capital was a lender to, these are not the kind of credits that the banks are trying to solicit. So it'll be very interesting to see who would be willing to buy the pieces of Home Capital if they're forced into a liquidation. And I suspect we're going to find that out very soon, because they have retained, I know, Royal Bank and the Bank of Montreal to explore strategic alternatives for the company. So it looks to me like they might be trying to position the entity for a sale or a breakup. But exactly where that goes, I think we're going to have to wait to see what kind of due diligence BMO and RBC, when they complete it, what the recommendations might be.
Now, in the beginning, you said that the bond yields, they're signaling a recession. And I wanted to get your take on how this would affect the derivative market if we're heading into a recession where we might see the stock market come down, where we might see things, start to happen within the economy. How would this affect then the derivative market?
Well, Dave, it's interesting with regards to the derivative market. What's been going on really in the past 18 months is we've seen a significant reduction in the aggregate of outstanding derivatives held by the big American financial institutions, as reported by the Office of the Comptroller of the Currency in their quarterly derivatives report. The latest numbers we have are from Q4 2016, and at December 31, the value of outstanding aggregates held by the American financial holding companies totaled $222 trillion, which was a decrease from $243 trillion in outstanding aggregates at Q3 of 2016. And the amounts outstanding of the American bank holding companies, I believe, had a high water mark about 2.5 years ago, over 300 trillion. And we're now down to 222. So the amount of outstanding derivatives have been dropping, and have been dropping at a very, very aggressive rate. So, I mean, to get back to your question specifically, what does rising or falling rates have to do with derivatives, or what kind of systemic, or what kind of feedback does that create when what I can say is in my experience, it's volatility in interest rates that cause or wreak havoc in large derivatives books. And the reason for that is because the banks which try to play hedged books, their hedges are dynamic. And when there's extreme volatility in interest rates, the value of the hedges can be altered dramatically in a very dynamic environment, or when rates are really whipping around, which is why we've seen very, very, very gentle movements in rates, because the powers that be understand that extreme volatility in interest rates can cause banks to get wrong-footed with the hedges in their derivatives books. So, I guess really the reality is we haven't seen interest rates move dramatically enough, at least in my view, to cause any major commotion in the books of the big banks. And should that occur, because I believe it did occur in the 2008 timeframe, when they were dropping rates, plunging rates, short-term rates in particular, from like 300 basis points down to zero. I do believe in that time frame, institutions like Morgan Stanley possibly were wrong-footed, might have been insolvent, but just bear in mind that the U.S. has this funny little law on the books since 1934, and that law allows a designate of the President of the United States to excuse a company from publishing accurate financial, its actual financial state, which means that if a company were given a waiver, they could keep two sets of books and they could falsely report that everything is well. Effectively, they could have accounting suspended. So if you have a bank that's technically insolvent, but they've been granted a waiver where they don't have to declare it, and by virtue of this law, it's legal for them to lie. How would we know? And this law that's been on the books since 1934, there's absolutely no doubt in my mind that this waiver was in use during the financial crisis in 2008. And I completely believe that Morgan Stanley was operating under that, and Goldman Sachs might very well have been too. So that's what my view is. The law is on the books. There was reporting about that law in the 2006 timeframe that about the authority being transferred from the president's office to the chief intelligence czar of the designate of the president, who at the time was John Negroponte. And the fact that they were transferring the ability to enact this law tells me that it was very likely in use, because you don't dust something off from 1934 and make a public pronouncement about it unless you're either using it or contemplating using it. And I believe it was in use.
I mean, if they're using this law, how would anyone ever know how any of the banks are doing if they are using this? It would be impossible.
It's what it amounts to. It really becomes a real shell game, and I think we've been in positions where shell games have been being played, and to what extent the shell games will continue in the future. I don't know. And I'm not necessarily saying at all that I think the shell game is being played right now, but I do believe it was certainly being played in the 2008 timeframe.
Now, I just wanted to go back for a moment to the Fed and their interest rates and with derivatives. If the Fed decides not to raise the interest rates, and I remember they've been telling us that the economy has been improving, since Obama handed off this incredible economy to Trump, and they said they were going to raise interest rates, multiple times during this year. And if they all of a sudden say that the economy is not doing as well as it was before, and they start lowering the interest rates, I mean, what effect is this going to have on the stock market, on derivatives? And if we're heading into a recession, is this going to be like a trigger where people are going to say, well, wait a minute, all of a sudden we're not doing well? Is there something wrong? Is this economy not doing what you said it was doing all the way going back to 2016 and 15? What's changed?
I mean, well, what's changed is that the recovery that's been being reported certainly hasn't been as robust as what's been reported. And there's a lot of people who argue that we very likely never really did come out of the deep recession from the financial crisis. I mean, things might have improved at the margin, but Dave, we do know for a fact, because we can follow the fine workings of forensic accounting professionals like John Williams at shadowstats.com, who reverse engineers data that the elites put out. And he tells us that if we measure inflation today the same way it was measured in 1980, we would very likely have double-digit inflation or close to it right now. He tells us that if we measured the unemployment rate today the same way it was measured in 1980, we would very likely have something just north of 20% unemployment rate. And through the doctoring of numbers and through the changing the definitions of what being employed is or what being unemployed is, you can make a situation where by the old methodology you'd have a 22% unemployment rate, but by the new method of counting or measuring what unemployment means, you can say that you have 5% or full employment. So this is the way numbers have been and methodologies have been changed through the years to basically make the economic picture look better than it is. And metaphorically, the best way to explain this, Dave, is if you stand on the 20-yard line and you put things in football terms, most people in America understand it pretty well. But if you put somebody on the 20-yard line and tell them to kick a field goal, a lot of people would have no trouble kicking a 20-yard field goal. But if we leave you standing on the 20 but move the goalpost back 30 yards and we still say you're kicking a 20-yard field goal, you really aren't. The reality is if you're standing on the 20, you can tell people that you're kicking from the 20. But what you're really doing is you're kicking a 50-yard field goal if the goalposts have been moved back 30 yards. Well, in the economic reporting parlance, they've moved the goalposts back 30 yards. And they keep telling us that you're on the 20, all you have to do is kick a short field goal. Well, the 20-yard field goal of today, if you in 1980 terms, it's a 50-yard field goal because they've moved the goalposts. This is why our employment picture looks much better than it is, and this is why inflation is reported much lower than it really is, because they've moved the goalposts. So, where does that leave us? It leaves us with a lot of people bewildered and confused and thinking it's their fault that they're not measuring up, because they've got officialdom telling them that, we're at or near full employment and that there's no inflation, except it's tougher to pay your bills every month because things that you need and things that you have to pay money for keep going up in price. But, with the way they measure inflation, if things go up in price, they don't count them. They substitute them for things that didn't go up in price. Anyway, this is the whole nature of economic reporting in officialdom.
Yeah, I agree with you. I mean, there's a lot of people that write into me telling me that how things have completely changed in their lives, where they can't find a job, they were laid off, and it's very hard for them to make ends meet today. And of course, the government and the central bank is telling us how great everything is, and they just throw out these statistical numbers, which kind of really mean nothing to any of us anymore, because if they're manipulated, who cares about them? And
Dave, what this has led to is the awakening of many people. This is why so many people have lost trust in the mainstream media. This is why so much of the alternative media has grown in popularity and grown in terms of numbers of who's listening. This is why you've seen the rise of the likes of the Breitbarts, the Daily Callers, the InfoWars, Alex Jones. These places are gaining the ears and the eyeballs of people and the clicks, because they don't report information to us in accordance with what officialdom is putting out. They apply a filter to the mainstream claptrap and give it to us in layman's terms, and they call out the lies that the mainstream media, who's in bed with the politicos and the financial controllers, they're in opposition to what canned mainstream pablum information is. So this is the world we're living in, but this is why people are waking up, and the rise and the awakenedness of people in the world, and the growing number of people who are awake, in my view anyway, probably means that the world as we've known it is probably not going to be viable on a go-forward basis, because people are sick of being lied to. And Dave, people understand and intuitively know when they're being sold a bill of goods, and we've all been being sold a bill of goods for a very long time.
Rob, I wanted to get your take on what Trump said. He just blurted it out. He came out with it, where he says that we should break up the big banks. What is your take on why he just all of a sudden said that?
Because it's the big banks. It's the big banks that have the derivatives books that have made a mockery of price discovery of strategic things in our world. To give you for instance, I told you just recently that at Q4 2016, the aggregate outstanding derivatives for the American banking system, the American bank holding companies, was 222 trillion. I believe that was the number. And that 222 trillion, let's just say probably 220 of the 222 is held by 5 institutions. And those 5 institutions are JP Morgan, Bank of America, Citibank, Goldman Sachs, and Morgan Stanley. And these banks, through their derivatives books, the lion's share of this 222 trillion is in interest rate contracts. Then there's another big portion of it that's in foreign exchange contracts, and another big portion that would be in commodities contracts or futures. And what these banks do effectively by participating in the interest rate derivatives markets and in the commodities markets, they effectively fix prices. In the case of precious metals, they suppress the price of precious metals, because suppressing the price of precious metals makes the American dollar look relatively better than it would. A quickly rising price of precious metal is a failing grade to monetary authorities, to central banking, and central banking is put in place to perpetuate the fiat currency of the nation that it presides over. And if you have precious metals prices rising, it diminishes people's faith and willingness to hold the sovereign currency of the land. This is why precious metals have to be suppressed. Energy contracts, whether it's natural gas or crude oil, their prices are rigged in accordance with geopolitical concerns and interests. Energy prices have been used in the past to crash the fortunes of countries that maybe don't see eye to eye with America in certain respects. And then you have interest rate contracts that are used to effectively, it's one thing to say you're going to lower the Fed funds rate to zero, but to actually get people to buy a 3-month T-bill yielding 5 basis points is another trick altogether. And that's accomplished by using generous applications of short-dated interest rate derivatives contracts called FRAs, where the Treasury can engage the banks to showing the banks risk-free profits if they engage in these contracts. But the upshot of it is they have to buy bonds at ever decreasing yields to lock in risk-free profit. And effectively, by doing this, it's the Treasury/Fed complex that can make the banks captive buyers of U.S. government debt at rates, at any rate they wish. And the real arbiter of where interest rates are and where they go, in my view anyway, it's the U.S. Treasury acting in conjunction with their broker, the New York Fed trading desk, who disseminates their orders to these big behemoth banks that have in aggregate, they have derivatives books numbering anywhere from 40 to 53 or 4 trillion dollars. I believe Citibank is the biggest one at the moment at around 52 trillion in notional.
So what you're saying, from what I'm hearing, is that by doing this, he would be breaking the banking system apart and maybe stopping the manipulation on precious metals. He would wreak havoc in the derivative market, and it would make it very...
Well, let's put it this way, Dave. The explosion in bank-held derivatives, the explosion occurred in the immediate aftermath of the repeal of Glass-Steagall by Robert Rubin in 1998. And what Glass-Steagall did is it separated investment banking from deposit-taking banking. And back in the day, Glass-Steagall was enacted because the politicos in America didn't want big deposit-taking banks risking the deposits of their depositors in the capital markets by making leverage bets on interest rates, commodities, or whatever. And by separating traditional banking from investment banking and speculation, it was felt that Glass-Steagall protected the depositors, from rampant speculation. But the repeal of the Glass-Steagall in 1998 meant that the deposit-taking institutions were now able to engage in much riskier treasury operations than they previously could. So what this basically did was allowed Citibank and Bank of America, the big deposit-taking institutions, to basically, it opened the spigots and allowed them to take massive amounts of risk in these derivatives contracts. And it's interesting that when Trump made his comments about breaking up the banks, he was answering a direct line of questioning regarding Glass-Steagall, where I believe a reporter asked him, I think the question was something to the effect that, do you think it was a prudent thing to do to have eliminated the Glass-Steagall Act? And I think he was asking him if he might favor a return of the Glass-Steagall Act. And it was to that line of questioning that Trump made the offhand comment that he might be in favor of breaking up the banks. So more than anything, I think he was giving a hat tip. Trump, to me, there was probably giving a hat tip to the notion that he knows that the banks have heavy hands in the markets, and he knows that the banks are being utilized as captive players to let's just say create premeditated outcomes on a macro level in markets. And I don't think he's against that. I believe Trump is against that.
So, Rob, where do you think this is all headed right now? I mean, can the economy just continually chug along the way it's been for the last couple of years? Or do you think we're coming up to a point where the economy is pretty much done?
I believe that the U.S. dollar is in extreme danger of losing its grasp as the world's reserve currency, because we've heard utterances from the other side of the world, whether it's Chinese, whether it's Russian. These people are not in favor of having the dollar continue as the world's reserve currency, as the world's trade settlement currency. And direct actions have been being taken on the part of Russia and China and others, making bilateral trade agreements with countries in their sphere of influence, where the dollar's being cut out of bilateral trade. Like, for instance, deals where Iran sells oil to China and they settle in Chinese yuan, rather than the traditional way an oil trade would have been done, would be for Iran to sell oil to China in dollars. China would have to buy dollars to settle the oil trade, and that's been bypassed now between those two parties, where they just do the deal. They do the deal in the Chinese currency, and the dollar is bypassed. So this creates less demand for dollars. And America has printed an awful lot of dollars. And what this means on a go-forward basis is the likes of China, Russia, Saudi Arabia need less dollars, because things in the world aren't being transacted in dollars as they were in the past. And this is why you've seen countries like China, like Japan, like Saudi Arabia, like Russia, decrease their holdings of U.S. government securities, because the world is changing into we are growing into a situation where the world's just going to need fewer dollars. And America continues to print more dollars because, America is still running annual deficits of a trillion plus a year. And, the historical biggest creditors of America, being Japan, China, and Saudi Arabia, they have been reducing their holdings of U.S. government debt. And the U.S. government debt is not shrinking. The U.S. government debt's getting bigger. And my real question, Dave, and I think we've talked about this in the past, and it's a question I continue to ask and nobody gives me a good answer: who's buying the debt? And my belief, it's the U.S. Treasury that's been buying the U.S. debt, and they've been memory holding it, and they're buying that debt through the Exchange Stabilization Fund, which is a dark pool of extreme wealth, likely many, many trillions of dollars worth of off-book wealth. And, it's the real question, Dave. How long can you keep fooling people? How long can you keep playing a shell game with people that they realize that you're just playing a shell game, and they take their pail and shovel and they go home and they say, we don't want to play at all? And how long does it become where countries realize that America has created way more money than they'll even admit to, and they say, you know what? You think that we work for a living to sell you goods that you pay for in U.S. dollars that you don't have to work for. And that's the kind of moment we're coming to. And that's the kind of thinking and the awakenedness that will dethrone the dollar as the world's reserve currency, because the world is waking up, because the evidence that these things have occurred is becoming quite blindingly overwhelming.
Rob, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
You can find me on the web at kirbyanalytics.com.
Rob, once again, thank you very much.
Pleasure being with you, Dave.